All right. So we have two more chapters left until we finish the semester. So in this chapter, we are going to learn about the methodologies where we can choose among investment alternatives. So we have learned in the previous weeks, we have learned about many topics and we have calculated the net present value of an investment project. And yesterday we have learned about rate of return calculation, and also we have learned about the payback period and benefit cost ratio metrics to evaluate the performance of municipal projects. And now we are just going to discuss what happens if we have alternative investment policies. Okay, so if we have alternative investment policies or alternative cash flow structures for investment plans, how we can choose among these investment alternatives. That is our discussion today. So the outline is as follows. First, we need to determine how we can set the minimum attractive rate of return to evaluate the investments. Okay, so we will have alternative investments for project implementation, and we are going to evaluate the performance of these alternative investments by looking at their performance metrics under a specific minimum attractive rate of return. Then we will see how we can select the project and how we can allocate our budget. And first, we are going to assume that the projects are independent. So what does independence between projects means? For example, whether you invest in a specific project or not, if it does not affect your decision on investing in another project, then these projects are independent. So you are making independent decisions about investments in these projects. So let's just say you have two projects. One project is a construction project. Another project is a new product. Okay, you're going to introduce a new product to the market. So one project is a introduction of a new product. The other project is a construction project. So your decision on the construction project, whether you invest in it or not, if it does not affect your decision, on the introduction of the new product, then we say that these two projects are independent. But just like that, there are mutually exclusive projects as well. What does mutually exclusiveness means? So there are alternative projects, but you can only choose one of them. Which means if you choose one of these projects, you are basically forbidding yourself to select the other projects. So you can only choose one alternative among these. So let's just say you are supposed to purchase a printer, and there are several brands of printer. Even though you have enough money to purchase all of them, obviously you are just going to purchase one of them, which means if you select one of these printers, you are not going to purchase the other ones. Okay, so these are going to be mutually exclusive projects. And there are other interrelationships between the projects, and we are going to see how we can evaluate alternative project investments if we have these other relationships. Now, the third part of today's lecture is going to talk about the reinvestment policy. And when we are comparing alternative project investments, we usually ignore the fact that the revenues coming from these projects in the intermediate years can be reinvested. So we are ignoring this fact. I mean, for example, if in one of the cash flow diagrams of one investment, if you are getting your revenues at an earlier time, then it would be possible for you to invest these amounts into other projects as well. Therefore, we actually need to evaluate the projects by using the reinvestment options as well. So dependent on the reinvestment alternatives, the evaluations can be slightly changed, and therefore we can give different decisions in different problems. So we are going to see about that as well today. So we are going to talk about evaluation of projects. in the beginning. So this is just going to be a review of what we have done in the previous weeks. So we have said that in the last 2 chapters, so last week on Tuesday and this week on Monday, yesterday I mean, we have learned how to evaluate a project by calculating performance metrics such as net present value and the rate of return. So net present value was what? It is basically the discounted sum of all future cash flows discounted to today under a certain interest rate, and that interest rate is requiring the minimum attractive rate of return assumption, right? So the investor decides about the minimum attractive rate of return and calculate the net present value of that project under this minimum attractive rate of return measure. Or you can use the rate of return measure. So you can basically compute the rate of return, which is the interest rate, under which the net present value exactly becomes equal to 0. And if your rate of return in the project, if it is greater than your minimum attractive rate of return, then you say that the rate of return of this project is greater than my expectations. My expectation is just the minimum attractive rate of return. Therefore, I would definitely invest in that project. So, but in all of these analysis, you make a analysis or comparison based on the minimum attractive rate of return that you assume. What is the definition for minimum attractive rate of return? It is basically the smallest yield rate at which a proposed investment would be acceptable. So if the annual return of a project is less than the minimum attractive rate of return, then that project is not acceptable. So you say that I would only invest in projects which have the annual yield that is at least equal to the minimum attractive rate of return. Now, we have mentioned earlier that the minimum attractive rate of return is a subjective interest rate. It's a subjective rate. For different people, the acceptable return rate can be different. Now, an ordinary person would definitely expect an annual yield of 20%, for example. But for a person who has enough capital and who can invest in many alternative projects, basically that person can increase his or her minimum expectations. So the minimum attractive rate of return can be large for that person as well. Again, when you evaluate different investment alternatives for different projects, the minimum attractive rate of return assumption is also dependent on the risk introduced by this project. For example, if the project that you invest is a risky project, for example, introduction of a new product into the market, that project is risky because that new product has not been tried yet. So we do not actually know how the market is going to respond to the introduction of that product. Therefore, there are some unknown regions of this investment, and because of that reason, an investor may evaluate that project with a larger minimum attractive rate of return in order to compensate the risk that it is going to introduce. However, if you are going to invest in a project which does not introduce any risk, for example, if you are a construction company, if you work in a construction company, if the new project is also a construction project, it is not a risk investment for you because, I mean, you have experience in construction already. So you know what to do about this job. Therefore, when you are evaluating that project, you may set your minimum attractive rate of return to a lower value. So here's the thing. How do we choose among investment alternatives? By looking at the rate of return values. Okay, so you know that we can calculate the rate of return of a project without knowing the minimum attractive rate of return. And even if you cannot set the minimum attractive rate of return, among multiple alternatives with different rate of returns, you can all choose the project alternative or the investment alternative, which has the largest rate of return. But would that be enough idea for us? I mean, shouldn't we look other things as well? Now we are going to discuss this in this chapter. I have told you, for small-sized investors, the minimum attractive rate of return may be set equal to the interest rate that is available at a local savings bank or other institution. Remember now, the minimum attractive rate of return must be at least equal to, at least greater than, or at least equal to the cost of the capital. So the setting of the minimum attractive rate of return depends on how you raise the capital that you are going to use in the investment. Now, small size investors, because they will not be able to sell corporate bonds or corporate stocks in the stock market, what they are going to do is they are going to apply for a credit or loan from a local savings bank or other credit institutions, and they are going to be offered the loan by being exposed to a certain interest rate. Their minimum attractive rate of return when they are evaluating their investments should be greater than this interest rate so they can make a profit. Now, if they are, for example, raising the capital by taking loan under a 12% interest rate, by being subject to a 12% interest rate per year, and if they use that money in a project where they make an annual rate of return of 10%, then this means they are experiencing loss. So they are going to pay interest at rate of 12%, but the profit that they are going to get is at the rate of 10%. So this is not acceptable. Therefore, these investors are going to decide about the minimum attractive rate of return or minimum acceptable rate of return by looking at the interest rate that is available in the local savings bank or other institution. And in that case, the minimum attractive rate of return becomes the opportunity cost of money. So basically, instead of investing in that project, if you have just invested that money into the money market, then you would have gained that amount, right? So, for example, if the interest rate is 12%, you could have just invested that money into the money market and you could have gained that 12% already. Okay? Now, your projects should have a higher rate of return than that. So, because if you invest the money into the bank or a account, this is not a risky investment, right? You are going to get the interest in any way. Okay? But I mean, you are interested in much more rate of return. Therefore, the projects that you are going to invest should have a higher rate of return than the than the interest rate that is offered by the savings account. And in that case, the minimum attractive rate of return becomes the opportunity cost of the money. Because when you invest it in a project, you are basically forbidding yourself to invest that money into the savings account. Now, for economically stable business organizations, you know that it's not the only way to raise capital to take a loan from the bank. You can also sell corporate bonds or corporate stocks. And the savings bank rate would be lower than the usual overall rate of return on investment. So for economically stable business organizations, we usually see that the investments that they make on the projects, they have a higher rate of return than the interest rate offered by the savings bank. And therefore, they set their minimum attractive rate of return equal to the firm's current average rate of return on total investments. So, for example, for the last 5 years, a certain business organization may invest in multiple investments. And for the last 5 years, they calculate the annual rate of return of all of these investments and then take the average of the last 5 years rate of return. Now, if the company intends to expand and get larger and larger, in that case, they need to set their minimum acceptable rate of return or minimum attractive rate of return to the current average return on total investments, so they can experience an increasing trend in their average rate of return. So, for example, in the last 5 years, if their average rate of return in past projects is 30%, so on the average every year they are increasing their level by 30% in their projects. So this is the average value, and when they are looking for investment alternatives in the future, they need to look for investment alternatives with at least 30% rate of return, okay, the return rate. Now, in these cases, the minimum attractive rate of return, in these cases for small size investors, if you set the minimum attractive rate of return equal to the interest rate offered by a local savings bank, or if you set the minimum attractive rate of return to the current rate of return average of the organization, all of these minimum attractive rate of returns are attainable rates, which means you can find such projects like that. It is possible for you to find investment alternatives with that rate of return. However, sometimes the companies set their minimum attractive rate of return purposely higher than the bank's interest rate, or they especially set it to a higher value than the firm's current average rate of return. For example, the company may have long range or long-term profit goals, and they would like to expand. So they basically aim for a desired future growth rate. In that case, even though their current average rate of return is 30%, they may only invest in the project with at least 40% rate of return. So this means they intentionally set their minimum attractive rate of return higher than the current average level. Or they can intentionally set these minimum attractive rate of returns to high levels to encourage the search for more profitable new ventures, or it may be chosen large to offset the high degree of risk attached to the investment. So maybe the project is too risky, so when they are evaluating that project, they especially set that minimum attractive rate of return to a higher level. Now, in these cases, the minimum attractive rate of return becomes a target rate with no guaranteed means of realization. So it may be, even though you choose your projects with or evaluate your projects with minimum attractive rate of return, now that rate of return may not be realizable at all. Okay, so it may not be attainable. It may be just an objective. Now, let's see how we can set the minimum attractive rate of return in the evaluation of these projects. In this question, and this is a case study question, basically. So there is not a solid solution method for this question. We are basically going to analyze the given information and decide about the proposal that we need to choose. It says the ABC company is currently earning an average before tax return of 25% on its total investments. So right now, their current average rate of return is 25%. So every year, for last a few years, every year they are expanding with a growth rate of 25% in the projects that they invest. The board of directors of ABC is considering three proposals as given. So we have proposal A, proposal B, and proposal C. In proposal A, we have the initial investment amount of $40,000, and for the following 4 years, we are going to get $18,000 in the end of each year. In proposal B, the initial investment is a little larger compared to the proposal A's initial investment. However, the revenues that we are going to get in the end of each year are going to be larger as well, as $25,000. And for proposal C, you can easily see that the initial investment is less than proposal B, and the annual revenues in the end of each year are $2,000 greater than compared to proposal B. So these are the alternatives here. Obviously, I mean, someone who is clever enough can immediately say that proposal C is a lot better than proposal B because its initial investment is less and the revenues as installments for the following 4 years are greater. Now, but let's just see the details about these proposals. Proposal A is for replacing one of their worn out equipment. So proposal A is what? There is a machine, let's just say, and that machine is worn out. It has been in use for years and years, and it has lost its efficiency. Now you are supposed to change that machine. It is urgent. I mean, if you keep continuing that machine, if you continue to use that machine, in that case, in the future, the efficiency of that machine or equipment is going to reduce further, and it is going to create much more losses. Now, maybe it is a necessity for you to replace that machine in any way. So it is a machine replacement proposal. The second proposal, proposal B, is for plant expansion. So you are going to expand your plants for a specific reason. Maybe you are going to increase the capacity of the production line. Now in proposal C, it is, now proposal C seems to be more logical than proposal B, but proposal C is something else. It is a little different than the plant expansion. So details of proposal C is a little different. So it is for an addition to ABC's product line, which could possibly fail in the marketplace, resulting in the loss of most of the $50,000 initial investment. So proposal C is the introduction of a new type of product into the market, but the corporate actually finds this project risky, and they feel that the product is going to fail in the marketplace. I mean, these $27,000 of revenues that we are going to predict that we are going to get in the following 4 years, and in the end of the following 4 years, these are just expectations, but there is also a considerable probability that this product may fail. We are just going to lose that $50,000 and we are not going to get anything at all. Okay? So the third project is risky. The first project is a machine replacement or equipment replacement, and the second proposal is related to a plant expansion. Now, as you can see in the remaining part of the question, the board feel that they would need at least a 40% rate of return on this project to compensate for its additional riskiness. Because proposal C is risky, more risky than proposal A and proposal B, they say that the rate of return for proposal C should be at least 40%. Should be at least 40%, so it can be a considerable project because it is a risky project. Which of these three proposals are acceptable? The question is this. So which of these proposals are acceptable? Now, let's evaluate the net present value of these proposals. But for evaluating the net present value of these proposals, I choose the interest rate, assumed interest rate is 25% for proposal A and proposal B, because I can say that my past rate of returns are on the average 25%. So I will set my minimum attractive rate of return to this attainable rate, and I will evaluate that these projects under 25% minimum attractive rate of return. However, for proposal C, I will intentionally use a target minimum attractive rate of return, which is 40% indicated by question. And in the first project, we have the initial investment of $40,000, which is a negative cash flow, plus for 4 years, we have a uniform series $18,000. Now, when we multiply this value with the uniform series present value factor or present worth factor, we get $2,508.97 net present value, which is positive. And it seems that the project A, proposal A, seems to be acceptable. Now we can do the same for project B, and we can evaluate its net present value under 25% attainable minimum attractive rate of return. And that is going to be the initial investment amount minus $60,000 plus $25,000 times the uniform series present worth factor, P over A. And that is going to be negative as approximately minus $1,000. And this seems project B is not economically justifiable. And when we evaluate the present value of the last project under 40% interest rate, that is going to be the initial investment in negative values plus the future revenues for 4 years multiplied with the uniform series present worth factor under 40% interest rate this time for 4 years. And the net present value is barely negative. It is negative, but that amount is a very small amount. If you compare it with the initial investment size, which is $50,000, $71 is nothing special. So even though the net present value is negative here, still we may think about investing in this project C, because even though the net present value is negative, it is not that small. Now, we can say that if we just check the net present values, we can say the proposal is acceptable because of a significant positive net present value. Okay. And if we check the net present value of B and net present value of C, they are negative and we can simply ignore them if we just check the net present values. However, we can also determine the rate of return values for these projects. Now, the A over P values for the first project, the annual revenues divided by the initial investment is approximately exactly 0.45, and for a capital recovery factor of 0.45, the corresponding interest rate that makes this ratio is 28.75. Now you can apply linear interpolation to determine this value, but you need to try that at home. Now we are not going to give any further information on the linear interpolation. Now you can determine the rate of return value by studying the previous chapter. And the rate of return for the first project is 28.75, which is greater than the attainable minimum attractive rate of return. So project A is logical in that sense. In project B, the rate of return is 24.07. So the capital recovery factor that is being equal to 0.41 and 69 under 4 years is obtained by the interest rate of 24.07% approximately, which can be found again by linear interpolation. And that is a lot closer to 25%, as you can see. Now, even we have said that because of the negative net present value of B, when we check the rate of return of project B, even though it is not 25%, it is enoughly large to say that it is very close to 25%. So by just looking at these negative values, maybe making decisions, haste decisions, is not a good idea, because you realize that the rate of return here is very close to 25%. Maybe this project is still considerable. And finally, based on the revenue, annual revenue to the initial expenses, the capital recovery factor must be equal to 0.54 for 4 years, and this is possible for an interest rate that is approximately close to 39.99. And as you can see, this value, even though it is less than 40%, which is the target rate, it is very, very close to 40%. I mean, so because of that reason, we should say that even though net present values give an idea about the profitability of a project investment, by just looking at the values, we should not decide immediately, because as you can see, for the third project, the target interest rate is almost caught, almost that target is obtained, almost. Therefore, maybe the third project is also a considerable project. Now, what are our recommendations in the end of this case question? Now, the net present value of proposal B and the net present value of proposal C, though they are negative, they are small in the magnitude. Okay, so the net present values are small in the magnitude. What does that mean? So you see, the net present values are no more than $1,000, for example, but we are talking about $60,000 and $50,000 of initial investment here. So even though these values are negative, they are not significant values. They are not very, very large amounts of money for this kind of people who would like to invest $60,000 or $50,000 to a project. Therefore, we should say that by just looking at the net present value, we should not make hasty conclusions. Now, the rate of returns, when we calculate the rate of returns calculated for proposal B and C are barely under the attainable rate and the target rate here. So the ultimate decisions concerning proposals B and C may have to be made on the basis of other considerations, such as ABC's long-term product strategies. Now, maybe ABC needs to take that risk. Maybe ABC needs to take that risk and they need to introduce this product in the market just to be the leading company in that market. Maybe it's a necessity. Even they see that risky, in order to survive in the market, sometimes they introduce these kind of products, new products, to increase their reputation in the market. Okay, so we need to consider other factors when we are making this decision, because the rate of return is sufficiently enough, large enough. So 39.99%. I mean, it's only at a small amount less than 40. Now, the company's ability to raise capital is also important. So if the company can find the capital to invest in all of these projects, maybe the company should invest in all of them. However, as we see here, proposal A has a nice rate of return that is greater than 25%. So the attainable rate. So investing in this project, which is the replacement of an equipment, it is going to further increase the average rate of return of the organization. So the organization will expand. And also the net present value is also positive. Therefore, proposal A must be given the highest priority. And actually, it is the replacement of an old equipment, we say. It is a good idea to make everything new. Therefore, proposal I must be given the priority. Then we may think about investing in project C or proposal C maybe, then proposal B. Okay, so how many minutes do we have until the end of this hour? So actually we have one more question here, but I'm just going to continue with this question in the next hour. So let's just stop at this point and stop recording.